We had a session earlier this afternoon where Alex Partners analyzed the data all the LPs attending IPM have given to us. And interestingly, 45% of their expecting new commitments are new commitments compared to re-ups. 45% of what LPs will do next year will be something new.
Okay. Yeah.
What new do you think will be, what new things are looking, the investors you're talking to, Michael, and what new things will you look at yourself, Jenny?
Yeah, okay. I mean, within infrastructure, some of the themes that clients are really trying to build into their portfolios are anything to do with renewables, but moving beyond the wind and the solar, which we all know. It's more to do with dealing with energy intermittency and more storage points and battery storage. Anything to do with data centers. There's been a lot of talk over the last few days about AI. And there's undoubtedly the amount of data that's needed to be able to power AI is just off the charts compared to cloud computing, which was the previous thing that drove data centers. Real estate is interesting in that there hasn't been a huge amount of conversation about real estate the last few days, but we see our clients expressing a lot of interest in looking at real estate again because I suppose real estate is more linked to interest rates. Interest rates have obviously gone up. Valuations have come down quickest. You often see that whenever there's a rise in interest rates. Real estate valuations are the quickest to change. Core real estate being down 10 to 20% is creating a lot of opportunities for investors, particularly in new themes, maybe outside of core real estate, in areas because of demographics. A big focus on maybe nursing homes and medical centres. In other areas, you're seeing a lot of more logistics, so anything to do with storage containers, truck trailers, which was an unusual one when I heard about that. And then within private debt, every session we've gone to where it's talking about multiple private market asset classes, everyone has been extremely positive on private debt, which I am also. But we think there's potentially going to be a distressed credit cycle next year, and we have a lot of RLPs doing due diligence on investment managers that have previously had, maybe post-COVID, where they launched a credit opportunity strategy, focusing on areas like special situations, lending, rescue financing, stressed and distressed debt. Because we think undoubtedly with the higher rate environment, there's going to be some companies who maybe don't have a private debt relationship and are working with the bank, and as we all know, banks are continuing to pull back from lending and looking for more standard valuation type companies that they can invest in. It's going to create a lot of opportunities next year for those private debt managers who have opportunistic credit strategies and have multiple vintages that they can show they've not managed to do it in the past.
Jenny, do you think it's a good time to look at new things?
Yeah, I mean, it's really interesting that stat that you mentioned, and it's thinking about it, it's probably not that surprising because certainly when we do our pacing exercise, which we do every year to set, how much we're going to deploy for the program this year, and we build out our sort of blueprints. If you look back the last 6 years or so, you've had to assume this 2.5 year fundraising cycle for managers, because that's what it's been. If you were assuming 4 years, you were getting really caught out. So there was no room for new relationships. It was just trying to keep pace with your re-ups. And now that's getting pushed out. So when we did our pacing exercise this year, we said we don't think anyone's back in 2.5 years anymore. Let's push it back out to 4. And actually, suddenly it creates room, assuming you're not over allocated, which is the case for us. It creates room in your portfolio for new relationships. And so that makes our job very interesting. I think you can be more targeted in instilling your views on your portfolio when you're adding new things rather than just re-upping. Obviously we stay with our relationships for a long time and it's a relationship business, but it is more of a reactive sometimes process, whereas when you actually have more of a blank canvas, you can really instill views on what do we think is really interesting now. I think Michael and I might be the only people at the conference that are seeing this distressed credit cycle coming back, so maybe that'll be our panel for next year. But I think there's something there, but I think for us, given our return objectives that I mentioned being so punchy, we've got to convince ourselves it's there and it can deliver on our return objectives. But I certainly think the distressed credit cycle is playing out, and it is an area that we're interested in. Energy transition is also an area that we're interested in. And funny enough, as you mentioned at the start, we've just opened our first international office in London. And so we're obviously going to be weighting our deal flow and our sourcing activities in the European market at a time where arguably from a macro perspective you wouldn't necessarily be doing that from a top-down view. But one area that I think, Europe actually has a more attractive opportunity set to invest in is in energy transition. I think the US has been, they're sort of playing quick catch-up, but they just don't have the same maturity of the market and the opportunity set around it. There's still a lot of risks in that opportunity set, and there's still a lot of investment types that just don't fit a traditional private equity portfolio, very capital intensive, development risk, technology risk, that the sorts of risks that generally don't pay the returns that we need. But there's enough of an ecosystem building that I think you can access the business models you want to invest in that are also supporting the energy transition, and that's one of the things we're kind of trying to look for.